Right now, somewhere in Ohio, a data center the size of a football stadium is burning enough electricity to power a small city. Its only job? Guess a number. Not solve a problem. Not build anything. Just guess. Over and over. Trillions of times a second. And every 10 minutes, one machine, somewhere on Earth, gets it right and gets paid. That's Bitcoin. That's the whole show. And right now, it's sitting at just under $65,000 a coin. Down almost half from its peak. Up nearly 3% this week alone. So here's the question everyone's whispering in group chats and shouting on finance Twitter. Is this the calm before the next explosion? Or the last gasp before it deflates for good? Let's find out. Here's the thing about Bitcoin. It doesn't move slowly. It doesn't ease into anything. It smashed a new all-time high, over $126,000, back in October last year. Then it did what it always does. It fell off a cliff, nearly cut in half. And now it's clawing its way back, on the back of something almost nobody outside a Bloomberg terminal cares about, a weak jobs report. Fewer jobs than expected, unemployment ticking up. And suddenly, traders are betting the Federal Reserve blinks, cuts rates, and cheap money goes looking for a home. Bitcoin's home. That's the pattern. Bitcoin doesn't run on vibes. It runs on liquidity. And liquidity is a drug the whole market is currently jonesing for. So the real question isn't, will Bitcoin go up? It's, does the machine underneath it actually support another leg higher? Or are we just watching the same roller coaster car climb the same hill for the fourth time? To answer that, you need to understand what's actually happening under the hood. Strip away the hype. Bitcoin is just three things stacked on top of each other. 1. Scarcity. There will only ever be 21 million Bitcoin. Ever. Not 21 million and one. Right now, about 20 million are already out there. Roughly 95% of the entire supply that will ever exist has already been mined. 2. The halving. Every 4 years, the reward for mining a new block gets cut in half. Less new supply hitting the market. Same, or growing, demand. Basic economics says that should push the price up. Historically, it has. Eventually. 3. The guessing game. Remember that data center? Miners around the world are burning real electricity, real money, competing to solve a math puzzle first. Winner gets new Bitcoin. Loser gets a power bill. This is called proof of work, and it's the thing that makes Bitcoin expensive to fake and expensive to attack. Put it together and you get a currency that nobody controls, nobody can print more of, and everybody has to fight, with electricity and computing power, just to create. Sounds almost noble, right? A pure, scarce, decentralized asset, free from the manipulation of central banks. That's the pitch. Here's where it gets uncomfortable. Bitcoin was supposed to be for everyone. In practice, it's astonishingly concentrated. A small sliver of wallets, the whales, control a massive share of all circulating supply. When they move, the market moves. Not because millions of retail investors changed their minds together, because a few dozen entities decided to. And here's the irony nobody puts in the brochure. An asset built to escape centralized control is itself controlled by a tiny, centralized group of massive holders. Then there's the other twist. Bitcoin's price today isn't really being driven by Bitcoin. It's being driven by the Federal Reserve, the exact kind of institution it was designed to root around. A soft jobs report drops, rate cut odds rise, Bitcoin rallies, inflation data comes in hot, rate cut odds fall, Bitcoin dumps. That's not the behavior of digital gold immune to monetary policy. That's the behavior of a leveraged bet on the Fed's next move, dressed up in a hoodie. And the market cap? About $1.3 trillion, sitting on top of a market where daily trading volume is a fraction of that, meaning it doesn't take a wall of money to swing the price. It takes a nudge. So when you hear Bitcoin is up because of institutional adoption, sure, partly true. But a lot of the machinery moving this asset is the same old machinery. Interest rates, leverage, and a handful of very large players. The revolution runs on the very system it promised to replace. Let's play a game. Hype versus reality. Hype, Bitcoin is the ultimate inflation hedge. Reality, it's down roughly 48% from its all-time high, even as prices for everyday goods kept climbing steadily the entire time. That's not a hedge. That's a roller coaster with a really good marketing team. Hype, institutions are all in. This time is different. Reality, Institutions trade in and out based on the same rate expectations everyone else trades on. They're not believers, they're allocators. When the setup changes, they leave, fast. Hype. Fixed supply means the price only goes one direction, up. Reality. Fixed supply controls how much Bitcoin exists. It says nothing about how much anyone's willing to pay for it. Scarcity sets a ceiling on supply. It does not set a floor on demand. Here's the quietly funny part. None of that means Bitcoin can't run. It absolutely can. It just means the honest answer to, is it ready for the next big move, is less exciting than either camp wants to admit. Zoom out far enough, and Bitcoin stops being a coin and starts looking like a stress test for the whole financial system. Every time it swings 40, 50% in either direction, it's testing something. Whether exchange-traded funds holding it can handle the redemptions, whether regulators will step in, and how hard. Whether retail investors, who often buy in at the top out of fear of missing out, can survive the drawdown that almost always follows. And there's a bigger, quieter risk sitting underneath all of it. Bitcoin has become entangled with traditional finance in a way its earliest believers never wanted. It's in retirement accounts now. It's on bank balance sheets. It's collateral for loans. Which means when Bitcoin falls, it doesn't just hurt the people who bought it. It ripples outward, into the pension fund, into the ETF, into the credit line backed by it as collateral. The thing built to be an island got a bridge built to it. And now the tide on that island affects the mainland too.